Well, welcome everyone today, and thank you for joining us online. And also thank you for taking the time out of your busy days to tune into this webinar. My name is Adam Muston from Income Asset Management, and we are joined by Daniel Saldana. Daniel is the head of credit at IAM Funds and the lead portfolio manager for the IAM Global Credit Opportunities Fund. Thanks for joining us today, Daniel, and obviously thank you to a lot of those existing investors who have joined the call. We know you are familiar with Daniel. This is really a webinar just to go over Daniel's case for credit in the current environment, some thoughts on the market, and then just diving into the portfolio a little bit further. But, I do think before we go on, it is safe to say we are probably at quite a pivotal point in the markets. Looking back to earlier in the year, investors were really predisposed to the idea that, a global recession was almost a certainty. Better than expected corporate earnings, moderating inflation, it's probably challenging that view a little bit. And I think we have seen a sharp pivot in the market's views, and it's almost in pricing in quite a softer landing. But I think it is important to forget that we are actually only at the start of unwinding a decade of easy money. So I think, before we dive into this, Daniel, as the title suggests, we do believe it is a credit pictures market. But maybe, Daniel, just to, for those members on the call today who aren't as familiar with yourself, maybe just a quick background, if you don't mind, and just introducing yourself and your experience in credit markets.
Thanks, Adam, and thanks everyone for joining the call. I'll keep this brief. So I've been in the credit markets my whole career, which is about 22 years, and I've been really fortunate to be an investor for the vast majority of that rather than a structurer or a banker. And I've also been able to do that with a broad mandate which focuses across geographies and be across public and private markets. So I feel very fortunate. I started my career back in the early 2000s at Credit Suisse, and that was really structuring and originating private credit before it was called private credit for financial sponsor and private equity clients. And then, in early 2008, I moved over to be a distressed and special situations investor for Marathon Asset Management in Europe. But for the last 10 years, I've been focused on, global high yield credit and Australasian private credit. The mandates which we're running today are really an evolution of the mandates which we were running at River Capital for the 7 years before this, and the mandates that I ran at Bentham and co-managed while I was there. So we've been doing this a long time and love what we do, but we also think it's a really attractive point in the cycle in the market right now.
Yeah, great. Thanks, Daniel. And sorry, before I go on, I should have mentioned this will be interactive, this session, so please offer some questions in the question box on the right, and we'll do a bit of Q&A at the end. Feel free to challenge Daniel on any of the stuff that he brings up, or also just, if you've got some things you want to focus on, please drop those in that question box and we will answer those questions. But I guess just to kick things off, Daniel, as we really set the scene in that case for credit, can you talk to us why you do believe, in this particular environment as an active credit investor, it is one of the richest you have seen in a generation?
Sure. Look, I think it's really straightforward. We think the case for credit is compelling through the cycle. We think there's a place in people's asset allocations, particularly in Australia. But right now, the odds are really in our favour. We're looking at a US $5 trillion opportunity set in our core markets with yields approaching double digits. We haven't seen yields consistently this high since, I began my career in the early 2000s. So when I started, base rates were about 4 or 5%, and yields were, and credit spreads were at 4 or 5%, so 8 to 10% total return. Shortly thereafter, yields and spreads collapsed to, to mid-single digits. They spiked in the GFC for a short period, and then the financial repression and easy money came in, and we've had a prolonged environment with suppressed yields and suppressed spreads. Okay, with the odd bump. We're looking now at a complete step change, and it's a reset the playing field in our world. If you're earning nearly 10% for taking credit risk, that's double the return of a couple of years ago. And a couple of years ago, we'd look at opportunities and go back in history and say, gee, I wish credit spreads, total returns were back at 10%. We're there now. And I think if you put it in context where long-term equity returns have been in the high single digits, if you're taking credit risk for very similar return profiles, that's a great starting point. And I think the other nuanced point is we think that credit markets and fixed income markets have already largely adjusted mathematically to just have to the new interest rate environment. But we're finding it really difficult to reconcile equity market valuations. If there's a real disconnect there. Now, that doesn't necessarily mean that equity markets are correct, but it just means that the return expectations for equity markets, given that valuation disconnect, are harder. So we think we're the playing field and the opportunity set which we're looking in right now is super rich.
Yeah, no, I think that's a great case for credit there. But also, I think it's probably just looking at some of the Australian investors. I think there's been a traditional approach to some people using a passive approach to credit, and they haven't really focused on those inefficiencies that do exist in the liquid credit markets to generate alpha, which you and the team obviously think that passive has its failures. Maybe just expand, if you can expand on why you take this active approach, and I guess the flaws of a passive approach to credit.
Yeah, sure. Look, it's our view that there are both structural and situational inefficiencies in credit markets that can be exploited by investors with expertise, a rigorous process and well-designed mandates. If you're consistent and contrarian, you'll be able to generate, consistent alpha in credit markets over the long run. And just like public equities, credit markets have become increasingly passive and driven by passive mandates and large ETFs. The markets which we operate today are about 40 to 50% passive money. That certainly wasn't the case when I started my career. That presents really an opportunity, because by definition, the greater the weight of capital that believes that diversification and solves all issues and that prices are always efficient, the more likely there's going to be mispricing. And we see regular and consistent divergences from fundamentals that are driven sort of by mandate related issues or market technicals, rather than the performance of the underlying business and the credit quality of the issuer. And we think that's a real opportunity, and it's certainly a structural feature of credit markets that doesn't seem to be going to be disappearing anytime soon.
Well, I think that's sort of a good, there is that common market perception that high yield markets come with unreasonably high risk, and that you should only buy high yield when spreads are sort of 1,000 over. I guess how do you sort of respond to that?
Look, I've heard that 1,000 over argument a lot, and I get the appeal of trying to be pick the perfect point, but we're not market timers, and I just say careful what you wish for. I think if you're talking about credit spreads at 1,000 over, firstly, those periods are typically incredibly short, and the world is in very, very dislocated. Secondly, and not to be cheeky, but I think there's a real intellectual inconsistency if you've got, risky assets, as a core portion of your balance sheet, 50, 60, 70, 80%, and then you're not investing in a less risky outcome for credit spreads being at 1,000. Because if credit spreads are at 1,000, your private and public equity values are likely to be, down at least 50% without a clear path to recovery in capital, and you're unlikely to be able to sell or realize or even value your private market investments in private market portfolios. If you look back, if you'd had the worst timing of, and we've got a little chart which is in front of you. You think about, we 100% acknowledge that high yield comes with higher risk, but we think you're paid attractively for those risks relative to investment grade and relative to equities, and especially if you looked up on a detailed bottom-up basis, there's an enormous universe of businesses and industries that are high yield because one rating agency rates them, or one or two rating agencies rates them less than BBB minus, but the market prices that in the premium, and that premium has historically proved to be really attractive. So if you look within that context over 42 years, there's only been 7 years in the market with negative returns. 3 of those 7 are very recent, and that's really related to low rates and low total return probabilities, making prices more sensitive. But if you take the GFC, arguably the biggest dislocation in most of our lifetimes, if you'd had the worst timing of any investor, and in January 08 put 50% of your money in high yield, 50% of your money and loans, and 50% of your money in the S&P 500, roll forward 2 years, and high yield and the accredited investments in this space would have generated a high single digit return per annum, and you'd be more than square in capital. Your investment in equities took 4 or 5 years to get back to flat. So, I think no one likes volatility, and everyone likes to time perfectly. But these markets are really resilient, and it's not luck. It's because ultimately the underlying assets are riskier than investment grade, but still defensive. There's a floor to how far prices can fall, and that floor is pretty high, because for credit instruments to be impaired, equity, pref equity, any other junior capital, that needs to disappear. Like that. So there is a a hierarchy of how these things work. So 100% acknowledge that there's risks in the market, there's risks in every market, but we think that that you're getting paid attractively for taking those risks.
Yeah, thanks, Daniel. And I think there has been a fair bit of press around default rates increasing, particularly in the US. I guess how are you and the team really thinking about this risk, and do you think current spreads adequately compensate investors for this risk at this point in time?
Look, we undoubtedly think that defaults are going to go up, and that'll be no surprise to any professional investor in credit markets. Our expectation is for a prolonged high period of higher defaults akin to the early 2000s. So you're getting back to sort of 3 to 5% default rates across the market, which I think that's healthy. You need that's because suppressed defaults. It's a bit like equity prices always going up, or multiples always increasing. The rising tide raises all boats. That said, we're entering what we think is going to be a pretty weak period in a pretty strong place in these markets. Leverage is at multi-year lows in both high yield and in loans. Interest coverage, so your ability to make coupons, is at multi-year highs. So there is that valuation and cash flow buffer going in a cycle that will turn and get a bit worse, but you're starting in a really strong place. The other thing I'd say is that defaults, when you talk about it in the press, it's sort of this magic boogeyman, but in reality is that the market follows these things incredibly closely, and what you should be worried about is really unexpected defaults, and because that causes the biggest issues. The defaults that we've seen to date in the market, and we roll forward to the default expectations over the next couple of years, what I describe those as slow-moving train wrecks. Where they're heavily weighted towards a few issuers. And in fact, about a quarter of the defaults this year have been, second or third time defaulters. So chapter 22, chapter 33s. So we can argue about the right price or recovery value for those assets, but it's not a massive surprise to any credit professional that those companies defaulted, if they were doing their work. The other really important point about thinking about this is that credit quality and security selection absolutely matter, because the default outcomes are very, very different depending on where you are in the credit spectrum and your industry positioning. So if you're in a cyclical triple C going into a recession, your probability of default is really, really high. But if you're in staples, in defensive industries, in double B land, the chance of defaulting, even in a tough economic environment, and the chances of capital impairment are incredibly low. So over that 25-year period, double B credit you've got a default rate of 0.72%. You're earning a very healthy premium if you move just from investment grade to double B. So, that, and then a double B today is yielding, 7.5%, 8%. So you think about, the premium for the risk, and that's really attractive. If you move down to single B and triple C, obviously there's more risk, but you can be super selective, and there's plenty of opportunities when you can learn equity-like, and when I say equity-like, I say, 10, 15% total returns from taking credit risk, where we think the recovery outcomes are there. So, from our perspective, we think those characteristics are there. We keep a razor sharp eye on the market and what that's looking like, downgrades and defaults. But we'll assess every risk on a bottom-up basis. If we don't know the business and the industry, if we can't reasonably forecast cash flows, if we don't understand the capital structure, and we don't have a material margin of safety from valuation, then we just simply don't invest. And I think, being sensible about allocating investors' capital is, a key part of how we do things.
Yeah, no, thanks. And I think, maybe just further to elaborate on that, you did touch on that opportunity set and, I guess the market view there. But, really given the size of high yield bond market, the loan market, structured credit market, and particularly looking at it from a global lens, maybe just talk to, how you and the team do construct that portfolio to really hone in on those, best 30 to 50 issuers that you sort of see at a current point in the market.
Sure. Look, ultimately, we are bottom-up investors, but before we even start dissecting balance sheets, looking at cash flows and analyzing credit documents, we spend, a hell of a lot of time filtering the universe, and we've got, the systems, the infrastructure, the templates in place to do that to quite a bit of detail, and we do that very regularly. That filtering process is really about allocating time and capital to the best opportunities, on a risk-adjusted basis, rather than trying to cover everything. I think, there's an element of, if you've got, 50 analysts looking at sectors, and you've got every analyst has got to have 10 books in the name, it's, choose the least worst. It's not necessarily the best. So, we'd rather not do that. We'd rather just pick the best opportunities and do the work and construct the portfolio on that basis. When we think about industries and how we look at stuff, I guess, for better or worse, Anthony and I have quite a few grey hairs, and we've worked hard over a long period of time. So we've covered a lot of industries, at least superficially, but in a lot of detail over those years. And so we can come up to speed pretty quickly. But we also know what we don't know, and if we can't pass the reasonable man test about, do we know it well enough? Can we reasonably forecast? Are we compensated? And similar to bottom up, we don't look at it. So if you look at the chart we have on the screen right now, even within high yield, there's a very large dispersion in yield, even by industry. If you take the next step down, each of these industries will have anywhere from 30 to 50 issuers with and maybe 100 underlying bonds and loans, with a vast variety of yield outcomes. Because we've got the screening in place, what we do is we look at those fundamental screens very similar to an equity manager, but with a credit lens. If an opportunity presents itself, we just roll our sleeves up and do the work. Realistically, we say that 80% of the opportunities that we look at, we say no to for some combination of, we think the price is wrong, we think it's too risky, or we just need to follow it a bit more. Sometimes we joke that I'm the abominable no man, say no a lot, but that's okay. We're not. I look at it and say, if we're doing a really rigorous job, we're not going to get everything right. We're not going to pick every single winner, but we're about avoiding disasters, deploying capital really well, and being sensible, because we've got our own money in this fund, and we treat it that way we trade it with an investor first, with can I tell my grandma that I'm doing the right thing, and on top of that, that bottom up process, the portfolio construction is around minimizing risk and trying to do no harm. So, we're strict about industry positioning and size, position sizing, and concentration. And, that's not always, like occasionally we really like something, and if we were being super aggressive, we'd say, oh, we should be at 20% of the portfolio. But we just don't do that, because, we understand we're stewards of people's capital. And by having those constraints where it allows us to stay focused, minimize the risk of overconfidence, and also continue to hunt for opportunities. So, we spend a lot of time just thinking about not only, the bottom up, but also, how to access information, but also how to construct the portfolio.
Well, I think that's probably a good segue into another question, maybe just dive a little bit deeper into that current positioning in the portfolio, and I guess maybe specifically some of those sectors you do like, but also some of those sectors you're probably avoiding at the moment.
Sure. So if we, I'll just touch on the high level sort of portfolio stats. Today the portfolio is yielding about 9.5% to maturity, which equates to a spread of about 500 over base rates. We're diversified across 15 industries, heavily weighted to the US. That's really our natural position. In fact, our Australia New Zealand position is larger than normal, simply because we've seen some opportunistic investments over the last 18 months. When we think about industry positioning, we're positioned pretty conservatively at the moment. We think that the US, we know, as much as we'd like central banks and governments to thread the needle, engineer a soft landing and bring inflation back to target. We think that's that's challenging, and then it's a little bit like diving from a diving board into a glass of water. So great if it happens, but certainly not our base case. And quite frankly, we don't need to push the boat out in today's world. There's plenty to do where you're safe, you're earning very attractive returns, and you can preserve capital and optionality. So we tend to like defensive sectors. Where we can back cash flows. We like, the telecommunication software, retail, but we're pretty spread up, pipelines, but we're spread across a gamut. We're really cautious on consumer discretionary and retail. We think that those businesses will be really hard to forecast. They're really hard to forecast right now, particularly since they've had this periods of over earning and over cash flow and out of COVID. So it's really hard to set a baseline, which is the starting point before you forecast. And then we're pretty we're conscious that there's some things which are starting to look cheap, but potentially are still value traps right now, where we're doing a lot of work and trying to work out where's the best place, what's the right price. An example of that would be US REITs. Valuations have really come off, but it still feels a little bit like a value trap at the moment. We're doing a hell of a lot to get across the space, and because look at the whole sector is suffering from two things. We've got this cap rate normalization. Tell me what the right cap rate is for office assets today. It's not easy. And then you've also got occupancy pressures. So, because of that uncertainty where we can't really as yet pin down a normalization, and the prices haven't quite adjusted to take advantage to factor all that in, we're staying on the sidelines but doing work. And and kind of this point goes back to a bit of the process. Everything we say no to, we're really disciplined about keeping a watch list and target prices and thinking about that holistically. And so within the portfolio, what we've got combinations that we call core and opportunistic investments. Core investments are our defensive underwrites, where we're typically investing in credit investments with spreads of 400 to 600 over 8 to 10% total return. Where our work shows that the chances of impairment are very low and default and impairment are very low. That's about 80% of the portfolio. the opportunistic part of the portfolio is where, we're in situations where we're purchasing credit investments and what we think is well below intrinsic value, and that's where situations are at big discounts or where yields are really high. And there may be a chance of impairment in some of those scenarios, but we're buying at prices that more than factor that in. So if you think there's a chance of impairment where a bond or a loan will lose 20 cents, but if the bond or the loan is trading at 50 cents, that's a really attractive opportunity because you think that there's a total return prospect there that's that is super attractive, even if there's a default and impairment. So we look at that in the opportunistic market, but the threshold to take those investments is incredibly high. Typically, we've followed these businesses for multiple years. We've said no multiple times. We've set a target price, and then it's fallen through the target price, and then we've revisited, done a hell of a lot of work, sometimes reverse target price down again. So there's a process that you've got to have an incredibly high filter, but we do have a bunch of those now, and the flexibility of the portfolio to move up and down the risk spectrum and deploy capital when there's something that's dirt cheap is we think is really powerful.
Well, I think that was great, Daniel. But maybe just touching, you mentioned that that core and the opportunistic sort of split to the portfolio and how you sort of see the positions. Is it worthwhile just maybe bringing to life a couple of examples, one maybe from the core and one from the opportunistic that in the portfolio now, just at a high level?
Sure. Yeah, look, I'll give it really high level, and investors who'd like to learn more and delve into the detail, always absolutely welcome. This is probably the wrong format. I'll give you an example on the core. We own the first lien position in Arnott's. It's a brand we all know. It's hard to find a more dominant brand in consumer products in Australia in its categories. Like 73% market share in chocolate biscuits. It's amazing. We followed the business for years. We looked at it, when it was done in primary issuance and it was done as an Aussie loan and a couple of US loans. We passed at the time on the Aussie loan because we just didn't think you were paid for enough relative to the US loan on a credit spread basis. We then followed the US loan, and the company, with base rates readjusting and, the market volatility, we were able to, purchase that position, in sort of the mid 90 cents in the dollars in dollar terms, which is about 10%. Today it's about par, which is about 9% yield to maturity. But why is that attractive? You're talking about a business where, if you believe that KKR, who purchased the asset, paid fair value, the first lien loan's at about a 40% loan to value. So even if you heavily discount, we think 50 to 60% loan to value. The sponsor is doing actually a good job of executing. They're doing the right things. The business is performing pretty well, with their profitability and revenue, and they're investing in the right spot. So we look at it. You pay 9%, give or take today, in a situation with considerable equity cushion, very strong brands. An equity owner with deep pockets who's put a lot of money on the table, and it's also delevering. So we feel that that's really good risk, and we like some combinations or of that kind of position, of those kind of characteristics, or all of those characteristics when in our core portfolio. If I touch on the more opportunistic, part of the portfolio, I'll give you some high levels on another example. We currently own, a second lien or junior position in the largest Taco Bell franchisee in the US. That business is, incredibly stable. For 10 plus years, it's generated, mid-single digit revenue growth at 20% margins. About 90% of that drops straight down to cash flow. So effectively profits grow, cash flows grow along with it, and the company naturally delevers. We used to own the company's biggest competitor in a very similar, sort of second lien position that which was, subsequently refinanced when someone paid a lot of money for that asset. In the market dislocation, we saw an opportunity to buy this loan. Admittedly, it's a junior loan, but given the underlying characteristics of the business that can delever, given the fact that this, the financial sponsor has owned it for a long time and doesn't want to let go of it, and has been, very sensible about investing in the business. If you can purchase an asset like that at, we purchased it in the low 90s for a 7.5% yield to maturity. We think that's super attractive, and that's, but we still, even though we'd followed the space, looked at the business, looked at its peers, been invested in its peers, we still did a hell of a lot of work before we bought it. But those kind of opportunities, when they present, you do have to step in. And I haven't touched on it, but part of the reason that we can access these positions is simply because we're relatively small relative to many of the players. So the position that I just referred to on the opportunistic side, big players, and even when I had put my previous hat on, you have to deploy a large amount of capital. So if you need to deploy $50 million to move the needle on your portfolio, you're not going to look at something where the max position size you can take is $10 to $20 million in secondary markets. We have the luxury, because we're relatively small and the mandate's flexible, to, if we see that opportunity, extract that premium, right? Because it moves the needle and adds value. And if it's a good investment and you do the work, then you can reward from it. So, we really like to do, step in where appropriate.
Great, thanks, Daniel. And I think we've got a couple of good questions coming through from the audience, so thank you, and please keep them coming. But we might just jump to one of those at the moment, and it's just touching on, there's obviously been a big allocation to private credit, I'd say, in the last couple of years. So, I just, your thoughts on your views of, public versus private credit, and at this point in the cycle as well.
Look, honestly, we think there are more similarities than differences across the market. I think they're really not separate asset classes in my mind. It's just simple. It's separate liquidity terms and more than anything else, and scale. And we think there's a strong case for both in asset allocations. In our mind, the key advantage of public credit markets are three things. You've got liquidity, you've got transparency, and you've got the ability to, a greater ability to select. What do I mean by those three things? I think liquidity is powerful in both ends. As the people managing the fund, we can change our mind if the facts change in a situation, or if there's a more attractive opportunity that presents itself, and recycle investor capital. That's powerful. The world's an uncertain place at all times, and business is not easy, so things can happen, and the option to change your mind if the facts change is powerful. From an investor perspective, you can invest gradually with us, and you can also change your mind if your view on assets change. We hope, we always encourage investors to come with us, for a medium-term horizon, but as we don't expect you to be, 100% of your allocation at all times, right? So, and we're very sensible about making sure that we match the liquidity of our assets to the liquidity of our investors. I think the other point around it, the second point, is transparency. And I think in private markets and in private credit in particular, there's a large element of trust that managers have underwritten properly and are valuing their books properly. And the good ones are, and that's fine. But in public markets, it's very, very clear. I don't always like the market prices. Often I think they're wrong. But we value our portfolio on the market prices, and we have, and that transparency is there all the time, and we're accountable for it. And I think that's a really important thing to have. And the last point's around selection and origination. I think in private markets you need to originate if investors have given you capital, and there's an incredible pressure to deploy at all times. And if the opportunity isn't great at that point in time, you're going to dilute existing investors' returns with new opportunities. We don't really face as much of that pressure because we're really small, and we'll be even if we get to the maximum potential of this fund relative to the market. So we can scale and credit select and not dilute. We think that's incredible, right? So I think that those three things, we think that a product like this makes sense, relative to private credit and alongside.
Great, thanks, Daniel. And maybe just diving into one of the other questions here that's come through, it's just around the concentration of the portfolio, and just saying, is there a notional or absolute cap on a single name that you could have in the strategy? Just to maybe just highlight what that restriction is there.
Yeah, it's 5%. So we typically have a maximum 5% to a single issuer. And we don't go above it. It's in the docs. And it's when we get to 5%, it's pretty rare. We will very rarely go to 5% straight away. Typically, we take a 1 or 2% position after doing a hell of a lot of work, follow it, go to 5% if we've built higher conviction or pricing has moved in a favour to buy some more. So it's absolutely 5%.
Yeah, great. And just another question. Obviously, there's been a bit of a bias towards real estate credit in the last few years. I'm just noticing in the portfolio there isn't any exposure at the moment. To maybe just talk through the rationale behind that view and sort of your outlook maybe on that particular part of the market.
Sure. Look, I think it's by design to a large degree. I think the benefit of this portfolio is that we think that it's complementary to real estate exposure in this country. I think if you look at the average Australian balance sheet, and even if you're trying to actively avoid it, it's very hard not to be overweight real estate, directly or indirectly. I think the benefit of this portfolio is, even if we go to max real estate exposure, it's very little, and it won't. You diversify away, you diversify globally your holdings, you diversify away from real estate and financials and also resources. It's a separate issue, and you do that without sacrificing yield potential. So you're not really giving up a lot if you're earning 10% and diversifying globally and away from financials. We certainly think that I mentioned REITs in the previous, a couple of questions ago. The only real estate exposure we could take over the fund is, over time is REITs or potentially RMBS if it gets super compelling, but it'd only ever be, we've got an industry cap of 20%, so it could only ever maximally be 20%, and it's pretty rare that we ever go to 20% on anything. So just think about it as sort of somewhere between 10 and 20% if we were to max allocate to a sector. And then the last point around real estate, we think there's plenty of good real estate deals out there and people who do a great job, but it's, I view the real estate credit as a subset of private credit. Much of the discussion we had before applies. And the big point around that is, real estate deals on the yield, it's hard to compare apples to apples, but we're talking, you think about scale and liquidity, and you need to be paid and have the documentary protection if you're in a real estate deal relative to what we have in the fund. So you think about it, the smallest company we have in the portfolio generates revenue of $500 million, right? It's a material business, and material businesses come with oversight, boards, disclosure requirements, all those checks and balances, which are valuable. And so if you're giving away some of those things for yield, regardless whether it's real estate credit, private credit, you need the document, you need, that level of documentary protection, and you need a premium. And investors can make their own decisions, but we certainly think that on a comparative basis, it stacks up pretty well. And then when you overlay that diversification benefit.
Thanks, Daniel. I just think another good question that's come through here, and one that all credit managers should have experienced at some point. But just around defaults, have you experienced any in the portfolio? Maybe just briefly touch on an example there, if you don't mind sharing with the audience. Thanks.
Sure. So look, we certainly have experienced default. In COVID, we were invested in a cinema operator, but I guess it's a question of how you handle those defaults and how you think about preserving capital and getting the best outcome. So when that business, we invested that business pre-COVID, off the back of that it had made, a big acquisition, and then the loans had traded off, because, there was some integration risk, which we thought was, on balance, well compensated for. For context, rates were zero and you could be paid 10% by buying this loan, which was first lien, in the low 90s. We did not anticipate COVID, and clearly when COVID happened, revenue went to zero across the space. Cinemas were shut. Liquidity was challenged. The first lien loan that we bought traded down from 90 cents to 70 cents. We were pretty proactive, we're speaking to management, speaking to other participants, and to try and find a solution to, because you don't want to throw the baby out with the bathwater. We didn't know how long COVID would last for, but we suspected it would end at some stage. And it was thinking about sizing, enough liquidity to keep the business a going concern and preserve capital. The solution to that was, a hard negotiated super senior facility, which we were a participant on because we were an existing lender. That super senior facility had excess collateral, so there's super senior collateral to our loan, and you were paid 15% coupon cash pick, and then it had warrants and make whole premium. So it was a very attractive piece of paper. Because we were an existing lender, for our sins, and because it was a tough situation, we also had the ability to reinvest. It wasn't an easy decision. We did a lot of work and we did reinvest into that loan. We also sold the position that we had and reinvested that proceeds to buy more of the super senior. Now, and that again wasn't an easy decision, but we felt it was the right one, and it worked out pretty well. So, a couple of years later, because of the documentary protection, we got paid the coupons, and then the facility was refinanced at a premium. So, the IRR for the new money which we put in, was close to 30%. And if you take the original dollar that went into the loan, which we then sold and reinvested, that IRR was about 8%. It was a good outcome. Do we think that we'll have defaults in the future? Yeah, absolutely, we will. But we're not in the business of trying to engineer it. We're certainly trying to avoid them. What I'd say is, if you're speaking to credit managers who say, "I've never had a default," it should be just red flags to you, because especially in these markets, what it says to me is that they just sell to window dress, because if you've never had a default and you've sold something at 50 cents, and you should be getting 90 cents in the dollar, that's just a bad use of investors' capital. And there's a lot of nuance and work that goes around it. But we take this incredibly seriously, do a hell of a lot of work, and preserve capital by the credit work, by our understanding of processes, and I think really importantly, knowing what we don't know. So we don't do anything in emerging markets or anything where the bankruptcy process isn't really, really well known, and there's a playbook. So if you look at the US, it has a lot of sins, but it's got a superb bankruptcy and recovery process with a long track record and a playbook, so with known outcomes. So that's what we, part of the reason we like it. So, taking all those things in balance, we take that. We think that, the number one rule is preserve capital, and the number two rule is get paid more than you should for the risks you take, and that will look after the portfolio in the long run.
Thanks, Daniel. That's great. And we've got time for one really quick question, if you don't mind just touching on it. I think it's an important one. Obviously, to the team members are based down in Melbourne, which is fantastic to have you on the ground here. But you're taking a global view on your credit and taking your positions in the fund. Obviously, a lot of US-based high-yield investors, they embedded the local use over there. You've got a US election cycle coming through. I guess, how do you think about, constructing that portfolio from Melbourne and just the flow of information, particularly given you're heavily invested in the US?
Sure. Look, I think there's a couple of things. We think the quality of the investment work is not driven by where you sit. It's driven by the work itself. I think there's no monopoly on good ideas and quality work. We're sitting in New York or London by any means. And then, access to information is great, but you can be a bit of deer over headlights when you're sitting in the market. It just becomes, there's signal to noise is not there. So sometimes a little bit of distance and the ability to take a deep breath is important, which we have. So obviously, if there's a bump in the night, we look at it, but we're not. I don't think it makes a big difference. And having been offshore and come back, I would have had exactly the same concerns. But over the last 10 years, I find it works well. And sitting in our desk at our desks here in Melbourne, we still have the same market access. We're still talking to the same traders and salespeople and counterparties that we've talked to for 20 years. So it's like, aside from looking out and seeing Collins Street, there's really no difference to seeing St James's Park practically. The other thing I'd say is people ask this question about us in credit markets, but almost all the investors I know have either direct global equity or Aussie manager global equity portfolios. If you're comfortable taking global risk in big offshore companies right at the bottom of the capital structure, you should be comfortable with doing the same for a credit manager, particularly if you think about, well, there's an extra layer of protection because we're senior in the capital structure, and particularly if you think about the fact that we're dealing in markets where there's good disclosure, and we're getting the same information, similar aspect, similar access to management, and we're sitting here doing all the work. So I hope that helps.
Yeah, no, thanks, Daniel. And look, obviously we just put a couple of minutes over time, so we do really appreciate everyone who has attended the webinar today, existing investors and new to the strategy. Feel free to reach out to ourselves at Income Asset Management. As I said, Daniel and Anthony are very accessible. It's great having them in Australia, so always happy to jump on a call and talk through some more detail in the portfolio and the fund. There's some information online as well that you can see with the recent fact sheets and portfolio positioning, but feel free to reach out to a contact at IAM. Thank you again for your time today, everyone. Thank you very much, Daniel, and really appreciate you diving into the strategy and giving an overview on why it's a credit pickers market at the moment. Thanks a lot, Daniel.
Thanks, Adam, and appreciate everyone joining. And you know where to find us if you have any questions. So thanks again.
Thanks a lot.